Hello and welcome everybody to Street Smart Investing. I'm your host Albert, and this is the next video that I have for you for the custom portfolio that I have created. This next company, it's called CARR, and they're an AC company. They manufacture AC units, condensers, heat pumps, and air handlers, and all the likes. As you can see, I'm going to go over the same information that I went over last time. They have a good chart, and so let's begin. First things first, I'm not a licensed or registered or insured advisor, so please seek a professional if you're going to invest into the stock market. Again, if you like my selections, you can always watch list them, but again, I cannot make recommendations because it is solely based on your decision, and I am not responsible for your final decision since I'm not officially registered or anything like that. So any gains or losses, again, is on your accountability and your decision. So let's begin with CARR. The GBCP, I'm not sure what that stands for. So first things first, let's get this organized. It is Saturday, November 28th. And the shares for CARR is at $37.81. This company is fairly new. They used to be merged with United Technologies, UTX. So ticker symbol UTX does not exist anymore. So what happened was UTX merged with the Raytheon Technologies. So basically, it used to be Raytheon. I believe the ticker symbol used to be RTN. So RTN merged with UTX, and I believe the new symbol is RTX. Raytheon Technologies. Let me look it up just to show you guys, because I know. So okay. Sorry, I'm trying to look at the screen and here we go. So it is RTX. So UTX and RTN used to be two separate companies, and now they merged. So what happened was they got rid of UTX got rid of CARR as a standalone company, and they got rid of some escalator company. I forgot the name of it. But anyhow, moving on. They are a standalone company, and they provide, let's get the full profile. So yeah, they provide heating, ventilation, air conditioning, HVAC, refrigeration. That's actually what I do. But see, the thing is, some people might confuse this when they read this as like a contracting company. And even if they are, the main business for this is manufacturing. So again, these guys manufacture. They actually make the units. They don't really contract people to install this or service, whatever. They actually make these components and everything. They put everything together. They buy the metals and the wires and everything. They manufacture. So, okay, let's start with, let's go back to this info. Sorry, I'm a little bit off. So, yeah, so let's begin with the other info. Now we can start from the beginning all the way to the end. So, thank you for your patience. So, days range was at $36.46 all the way to 38. That's not a typical volume in the millions. Again, like the last company with Biogen versus AstraZeneca. When I see volume that's in the few millions, that tells me that a lot of people are buying and selling, and pretty much that's a lot of price action. So what I'm trying to say is that a lot of people, I guess, like the company, and there will be a lot of price action. So meaning the price is willing to go up. As you can see, it went up 196, almost 200% throughout this whole year, and 32.77 billion market cap. I usually write that in my notes. 52-week range, $11.50 all the way to 41. So it's close to reaching the maximum 52-week range. I don't like buying at a high, so I would actually wait for the next drop. As you can see, earnings are 1.8. They can definitely cover the dividend at 0.32 cents. The beta, which is like a volatility ring, they don't have any, but as you can see, it's pretty straightforward. You can see the whole year they've been going up, and even if when they went down, they were just a little bit flat here, and that's pretty much it. They've just been growing, a little pause, growing. So again, I like that chart, and that's a 1-year chart. As you can see, also the price book value per share, numbers are pretty decent, So as you can see, let's click on the max. You see, so this company came out not even a year ago, and yeah, I don't want that. There we go. So yeah, if you would have bought in March or April, you would have been sitting at about, what is that? Let's say 1050. If you bought all the way in March, and you would have gotten to $30 today if you round it off. So the profit would have been $28 about per share, and that's not including the end of the year, because again, we still got like at least 4 more months till March. You got December, January, February, March, so 4 more months. In that 4-month period, you definitely gain more than 28. I'd say at least $30 from the March low, and yeah, you would have gained at least $30 in a year per share. So next up I have is the order flow. Some people like to look at this, some people don't. It don't really matter to me. That's the order flow. As you can see, small orders outweighs. No, actually, the outflow, which is selling, outnumbers the small buying, and I think it's because of the large orders. As you can see, look, they got a large order. They don't have no large orders for selling. So yeah, and you have news. Some of these news titles on Weibo, they don't correlate with the stock. It's just like the most popular news sometimes. It's just a little ridiculous at times, but something that can actually relate to it would help a lot. So yeah, what's good about the AC business is that they can cool off servers. So I know that even for the home in general, even if you don't have a server, um just environmental control plays a big part in our day-to-day businesses. So if you look at it that way, aside from cooling off servers, people like to that live in people that live in hot climates such as me in Florida. um ACs are like a top priority. So I'm sure other places that are hot as well, like Texas and Louisiana and Arizona, ACs are a top priority, especially in households and other commercial buildings, and just day-to-day businesses as well. So as you can see, analyst ratings, I don't look at that, but I'm showing you anyway. These are price targets the analysts have. I don't really look at that. I don't really care. I just look at the 1 year. I'm not expecting it to be that price by the end of the year, or 1 year from now, from the date that it was bought, when you bought a share. I mean, I don't speculate, and I don't do future outlooks. I only do with what I have in the present. Sure, it's good to see the outlook on the future, but you just never know. And COVID taught us a lot, that um you just never know. I mean, the cases are going up, stocks are hitting all-time highs again. Where it's like deja vu all over again. And then again, I'm expecting a drop, and this time I'll be ready. And for sure, this is gonna hit us harder than last time, because we're in the winter months, and um, typically it's our body. We're warm-blooded animals. Warm-blooded creatures. So um, when we're warm, we can handle it, but when it's cold, it's just we're more vulnerable to getting sick when we're cold, because we're not cold-blooded, beings. So with that said, again, I'm expecting markets to go down in the next year. I'd say starting in early February. The funny thing is, I wouldn't be surprised if in late February the same thing happens all over again. When cases start arising, people, it's unfortunate that people pass away from this, or get sick or whatever. Some people choose to believe it, some people not. But again, we all know things are bad, and we just want them to get better. But again, the reality is things are just getting worse, and there's a good side and a bad side to it. We just want things to get better, but that's just not happening. That's all. So yeah, so it looks like there's a lot of buying between $24 and $38. That was the buying from that one day on the 27th. So we have that. Now let's look at the dividends. So they paid out twice this year. They paid out, I believe, in October. Yeah, and in July. I mean, it's not much, but a new company, considering a new company that's growth, they don't really offer dividends. So this is why I like the company. That was very, very unique. A new company on the stock market. They're not a new company in general. I'm just saying a new company to the stock market with the new ticker symbol is what I'm saying. So yeah, they pay a dividend. I know it's not much, but again, you still got really good growth. on it, and you collect some dividends with that as well. Earnings, it looks like they missed here, and they beat them here, and then maybe they met estimates, and maybe they met estimates. That's not definite, because maybe they already have cash on the sidelines to beat the estimates, but again, nothing has been reported. These are just future expectations that they want to have, but still, I like to be certain. And I know things can be I know some results can already be predicted, because that's already all accounted for. When some companies do that, it's like, okay, well, we'll have the money to beat the earnings or whatever, and everything's already set up. But again, you never know when things might get worse and you have to readjust last minute, and it just throws everything out of whack. So again, I don't mind looking at future outlook predictions when they do future earnings, but again, I'm not 100% counting on it, is what I'm saying. I like to just live in the present and see the present, and deal with all the real time data that's being presented at the moment. I don't like just, oh yeah, let me see how it looks in the future, and buy in advance, and I just go with the flow. Again, I just, it's hard to see the future, so um yeah, I know some people like to do that, but I just don't. So yeah, income. Oh, they have 2020 estimates already, or 2020 results. They didn't do too good. Oh, I don't like that. I don't like that drop. I do not like that drop from 2019 to 2020. Oh, so the revenue, that doesn't look right. They don't have nothing. That's got to be wrong. The revenue's got to be wrong. They nothing for, yeah, they got to have something. So what that tells me, I don't know if the income and operating income is inaccurate. So 2020 estimates, that's not bad. So from 22 to 8, so 8, 16, 24. So that's about 25% debt, or 30%, around that range. I'd say around 30% debt. And then we have a cash flow. Do they have 2020? What do they have for operating? What about investing? Nothing. I don't know if that's accurate. What, $16,000 for finance? 560. So they broke even. So they're negative 560, then 5. Yeah, they broke even. So yeah, they don't have a lot of rankings. Their rankings are off. But I still feel it's a strong company for the whole year. And that's all I can say. If it were me and I was in this position, and I had a share right now, I think I hold it for till March, because that's the date it started when they released the ticker symbol. I think after March I would probably sell, just because of the COVID stuff, and just to get in and out. And there aren't any rankings here. I don't know if this is inaccurate, or if it is accurate, or if things weren't posted. Yeah, this was, again, this was very odd to me. Total revenue negative 100. I don't know, that was off. That's a little off. So anyways, so yeah, there you have it. So now, so they have a good chart, paying dividends. They keep growing. So now let's compare them to the highest earner. The highest earner is LII. So LII is not on here. They're at 3. CARR doesn't even show. PE, LII doesn't even show. So let's look at that company. Let me look at dividend yield. I don't see them on here. Keep going, I'm still going. Everything's below 2%, going on 1. Wow, okay, so they do. So yeah, let's go back to that company. Those are the numbers. Whoa. So LII is $11 billion, 9.27 earnings. You can definitely cover the dividend. Very expensive, but a very good coverage from earnings to dividends, 3-to-1, 52-week range. PE's a little too high. I'm just doing a quick overview on this. That's flat. It went up, down, up, slightly down, then up. Majority is up from there to there. Dividends paid. That gap. So it beat the gap before it. It's going up. It's not bad. Orders beat that. Okay. No large orders, which is good. So you have a large order there. That I don't care about. So news. Oh, on 11/20 Goldman Sachs downgrades. So, they're probably looking to sell eventually if they downgraded. That's not good. So I would hold, actually, if Goldman Sachs is looking to sell. But there has been buying the past few days. Well, the past day. Average cost 245 to 90. It's a $45 difference. Buying, mostly buying, hardly no selling. So in the future, Goldman Sachs is probably going to sell. So you have that slope and then that slant. I use the 3-point contact method. So you got 1, 2, and 3 points. So sloping up. Another 3-point contact method. You see 1, 2, and then 3. Yeah. Support and resistance. So it could be flat right through there. Yeah, so it beat that one up here. This one beat that one. So, yep. It looks like it's on an uptrend. I do agree it's on an uptrend, but Goldman Sachs wants out. They're pretty expensive. So dividends 77. They've been raising the dividends. Okay. In 2020, they remain the same as 2019. Previous years, as you can see, guys, they've been raising the dividend. So 6 cents, 6 cents, 7 cents they raised it. Per quarter, I'm talking about, not overall. I just do it, per quarter. So from 43 to 51, that is 8 cents per quarter. So 8 times 4, whatever number I say, you just multiply it by 4 because they do 4 payouts in the year. So I'm sorry I haven't said the total amount. I just, I just state the one-time payout. Why is my camera blurry? Maybe because my hand's in the way. So that is done. Insider activity. This is very important, you guys. I didn't show this in the last video. I apologize, but this is very important. Inside activity. So last time they bought was in September 8th. 2 people. Oh no, sorry. Same person. Different amount. Same person, different amount. So 415 shares, 525. Let's round it off to 1,000. So 1,000 shares at $275. So, now, financials. Hold up, before I show financials, Lennox International. So, chart's not too bad. So again, I still like, so they are an HVAC manufacturer, but I will say this, I like CARR because it's cheaper and they still provide a dividend. This is just too expensive. Too expensive. So residential, heating and commercial, heating and air, and refrigeration, heating and cooling, range of furnaces, air conditioners, heat pumps, package heating and cooling systems, equipment and accessories, replacement parts. They do the same thing as Carrier. Same space, electrical components and equipment, as you can see. So, off to financials. So, earnings. Wow, look at that debt. I don't like that debt. This is why I do not like this company. So there you have it. What is the name of this company again? Lennox International Inc. Yeah, I don't like it. I don't even have to look at the balance statement and the income and earnings, and I don't like it. Earnings are good and they can cover the dividend. I'll give them that. I don't like the debt, and I don't like that they're too pricey, and I don't like that Goldman Sachs wants to sell some shares soon, as you saw that earlier. I do not have 2020 results. You can see year to year they're close to, they've been in debt since 2018. Income's gone up, revenue's kind of gone flat. That's a bad sign. Revenue flat. Operating is not too bad, but I do not like that. I've said it before, guys. Net income and revenue are the two most important. In that order too. Net income, then revenue, then, well, actually, some people consider revenue then net income, because once your revenue, your sales are up, your net income is gonna go up. So, they're both equally important to me. You know, I mean, I can't say this one's more important than this one, and net income is more important than revenue. They're just equally important to me. But anyways, this is primary priority, and this is secondary priority to me, for me, in my opinion. So yeah, I don't like that it's flat. Revenue's flat. Do not like that. Net income's not bad, but wow, it's a big drop. That is a big drop. That's over $2 a share that they missed. So there you have it. They're in debt. They're very expensive. But they can cover the dividend yield, and they are the top earners. And they might have switched management or something, because to be in debt like that and then miss that earnings, yeah. So there you have it. There you have it, guys. Lennox International Inc. versus CARR. So there you have it. Same kind of company, different results. Hope you guys enjoyed the video. Stay tuned for the next one.